So there's been some interesting stuff happening in stock markets, to say the least, in the beginning of 2020. One of the interesting, I think, sub-stories is really what's happening with technology stocks. It's a unique industry that's been hit intuitively, I guess, a little too hard if you're thinking about it. I mean, why is technology stocks in a COVID environment all of a sudden got hit hard? Well, the reality is you have to understand how stocks are really priced and what's happened over the past bunch of years. So first of all, what's happened over the past bunch of years is tech stocks have been on a massive boom. One, we've been in a favorable economy, and two is that interest rates have been low. And tech stocks usually trade, and growth stocks, that sort of whole demographic, usually trade at a higher price to earning, meaning that they don't need quite as much earnings to justify a higher price today. What they are doing is, and when investors look at purchasing them, is they look much further out. So they're more, think, longer term plays. You're willing to buy Uber or DoorDash or something like that because you think that maybe they're investing so much and not making a ton of profits today, but we believe that this technology will be here for years to come and will be a behemoth, will be the next Amazon or Apple. And because of that, we're willing to A, invest higher price to earnings, and B, with the environment we've had recently where interest rates are super duper low, that really affects our ability to, or opportunity costs, I should say, of what else we can do with those dollars. So it's been a really favorable environment for tech stocks. Now, let's bring that into current day here. So what we know is that with higher inflation that's been rearing its little head, the Fed has said they're going to start raising interest rates. What that means is that there's going to be less incentive for a lot of people to buy stocks that take longer to appreciate because the opportunity cost for their money is stronger today. They're looking for more financials or companies that are turning a higher profit in A, this environment that's coming up, and B, so for instance, financial stocks, while interest rates go higher and they have a higher spread on what they lend, and it bodes well for them. They also will earn more money now, and or I should say investors' tolerance to wait so long for a return gets discounted more in this type of environment. So that's what we really have seen. What does that mean? Well, it doesn't mean we at Diversified are suggesting to get out of technology stocks, although they have hit a correction territory, meaning 10% drop from peak to valley. And what it does mean is it speaks to a diversification, and what we've done is take more of a neutral stance to this industry. So we have overweighted growth or value stocks. We are taking more of a concentrated approach in the tech sector. For instance, we really like semiconductors these days. We think there's a big shortage in demand and not going anywhere. So we think the profits will continually be beefed up. So that's our take. We're looking at it as a more neutral weighting. Stay diversified. Don't panic with what's going on. Technology's not disappearing, but people's tolerance may take a little bit of a backseat for longer returns in the environment we have. Remember, soon you can put your money in cash, and if things keep going this way, you're going to earn 2%, 3%, 4%. So that's something we want to keep in mind when we do these things and invest people's hard-earned money, and something you should keep in mind as well. But I thought this would just be insightful because I thought it was insightful. I had to sit down and learn a couple of tidbits I didn't know from our CIO, who, again, I can't say enough great things. But that's all for today. Hope you enjoyed it. Got a little lesson. Read below as well as you have a little more detailed stuff. And as always, I'm Andrew Rosen. Stay wealthy, stay healthy, and stay happy.